Thanks very much, Johan. Very, very insightful, and I think excellently presented. Before we hand over to the next speaker, Ben Gerrit, just want to remind you, as you're following the webinar, send through your questions. We're certainly going to take all of those questions right at the end. So as you're going through, if there's anything that tweaks your interest and you want to ask a question, please feel free to do so. Gerrit, over to you.
Thank you, Chris. Good afternoon, ladies and gentlemen. Today I'm going to discuss two actual trades that we've done on the crude oil market, one being a hedge, the other being more of an investment, speculative kind of transaction. Before I get into the detail, I hope that you will humor me. The past week has been quite rough for us commodity traders. Gold price being down, well, 8% in one day. Oil also coming down quite a bit. And it made me think this morning, what is the difference between us commodity traders and a pigeon? Well, a pigeon can still make a deposit on a new BMW. Okay, I am going to be quite brief. I'm going to discuss hedge that we did for a large diesel consumer, where we fixed the price, we did not cap it. Just to recap what Johan mentioned, when hedging you can either fix or cap your exposure. You will fix by trading long futures, cap by buying long call options. Now, hedging is quite an involved process, and when we speak to clients interested in hedging, you know, we take into account a lot of what the client's business encompasses. Particularly important is his risk appetite, his cash flow tolerance, volume consumed, as well as seasonality of consumption. Farmers come to mind, they've got a very seasonal consumption curve. Okay. Furthermore, what one needs to keep in mind about the South African liquid fuel market is that the price you pay at the pump is determined in the previous month. So, for example, the price of diesel in August is determined by the average rand-dollar exchange rate in July, multiplied by the international price of diesel during July, average price. Okay, let's get into this hedge. On the 20th of June last year, we did a hedge for a client. He consumes about 1 million liters of diesel per month, and he wished to fix his price for 3 months, being August, September, and October. The instruments that we used was the September 2012 SAFEX crude oil contract, and the graph just shows. I'm also going to press the wrong button. The blue block is where we got in, and the green block was the hedging period. Just to put the price movements over the period into perspective. The basic calculations for the fixing of the price at the time of the hedge, the SAFEX September contract was trading at 710 rands per barrel. Now that's the equivalent BFP, basic fuel price, of 710 rands per barrel is 6 rand 35 per litre, and the projected wholesale price on that is 10 rand 24 per litre, and that will also be our reference price. 1 million litres per month of diesel equates to approximately 9,000 barrels or 90 SAFEX contracts per month. Now, the way we implemented this hedge, we bought 270 contracts of the SEP contract, 270 being 3 times 90. We bought this in June for hedging August, September, and October. So during those 3 months, the futures were sold. The hedge result, keeping in mind our reference price of R10.24. In August, the price at the pump was R10.25 per litre. That's an actual price increase of 1 cent per litre from our reference price. On our hedge, we made a profit of 24 cents a litre. So your net price, or your hedged diesel price, was R10.01, 1 cent a litre, which is actually significantly below the price at the pump. Then during September, the price was trading at R10.94, up 70 cents from our reference price. We made a profit of 68 cents a litre on the hedge, giving you a hedged price of R10.26. And in October, hedged profit of 87 cents a litre, total hedged price of R10.46. And looking at the averages, your average diesel price at the pump over the 3-month period was R10.84. Our actual average price increase at the pump, 60 cents a litre. Our average hedge profit, 59.7 cents a litre. So we were bang in line in fixing for the 3-month period the client's price that he effectively pays. Now, as Johan also mentioned, there are cash flows involved when trading on exchange. And basically the cash flow consists of 2 parts. Firstly, when trading on exchange, one needs to place an initial margin. That's a good faith deposit, normally in the range of 10% of the value of the contract. At the time of implementing this hedge, the margin on the SAFEX contract was 7,000 Rand per contract. We did 270 contracts, so that's just below 2 million Rand initial margin that the client needed to place. As we unwound the hedge as time went by to achieve the average price for the month, we closed our futures positions and margin was returned to the client's account. On the graph here, we've got the margin in blue. So you can see we start off just below 2 million Rand, and as time goes by, all the margin is returned, coming back to zero. The other cash flow issue or aspect here is your daily mark-to-market movements. That's just where profits are deposited to your account on a daily basis, losses subtracted. So for instance, if the price of oil goes from 700 to 710 per barrel, you'll be making a 10 Rand profit. On a contract of 100 barrels, that's 1,000 Rand. So if you held one future contract over a day where the price went up by 10 Rand, 1,000 Rand would have been deposited to your account. The red line shows your cumulative mark-to-market over the period of the hedge, and the yellow line is the combination of your margin and cumulative mark-to-markets being your net cash flow for the duration of this transaction. Now my second example is of a trade that we did for a hedge fund client of ours. It was a small test trade, just to show proof of concept. Now normally the WTI crude oil market trades in contango in the short term and in backwardation longer term. What that means is just in the short term, 2-3 months out, the price of the future is normally slightly higher than the spot price, and then as you move out further, 6, 9, 12, 24 months, the price of the long-dated future contract tends to be lower than the spot price. Now, I'm going to start off with the graph here. Normally, the price of the September WTI contract trades between 15 and 25 rands per barrel higher than the June contract. And typically during March, where we put on this trade, we're looking at about 17 rands per barrel spread, whereas the September contract trades above. However, this year during March, when we put on this trade, on the 22nd of March, the spread was only 3 rand 20 per barrel, and we expected that spread to open up. So what we did for our client was we bought September contracts and sold June contracts, 20 of each. So we were long 20 September contracts on crude oil, short 20 June contracts. Historically, up till June, that spread tends to open up to 20 rands per barrel, and that is our target on this transaction. Up till now, since we've implemented that trade, the spread has opened up to 5 rand 40, so we are slightly in the money, but still about 15 rands per barrel from our target price. Now, one would imagine that being long and short crude oil, that there is very little risk or zero risk involved, but as Johan mentioned, there is always risk involved when taking a view on the curve, which we did. Now, the two main risks that we identified in this trade was a change to the WTI forward curve or a South African interest rate cut. If you remember from our previous webinar, the SAFEX contract is basically a combination of the rand-dollar exchange rate forward as well as the NYMEX future. So should we get an interest rate cut, the forward points on our FX forward will reduce, and we'll see the further dated contract coming down. To mitigate the risk to our first risk that we identified, that being a change to the WTI forward curve, we went and bought call options. There's a risk that if you get a substantial increase in the near month's contract, the forward curve is going to significantly change because the further dated contracts tend to react more slowly. To mitigate this, as I said, we bought call options. Well, in fact, we bought a call spread just to make the protection slightly cheaper. So what we did was we bought 950 Rand strike call options, and to finance them, we sold 1,050 Rand per barrel call options. So the trade summary is listed in the table. For the June contract, we are short 20 futures, we are long 10 950 calls, short 10 1,050 calls, and we are then long 20 futures in the September contract. Margin on this is about 110,000 rands for this specific structure. The graph shows the possible outcomes to this transaction, possible profit and loss scenarios. The light blue line was on the 22nd of March. So we started off being slightly out the money due to the cost of our call protection. And the black line, which is probably the more important one, is what the outcome of this transaction will be. Now, if you have a look, should the price of crude oil come down, we are looking at a profit scenario of just below 25,000 rands per barrel up to 925 or 950. Should the price increase above 950, our call option, the 950 strike, kicks in, and that really turbocharges this particular structure up to a level of 1050, where our return call kicks in and our profit profile once again flatlines. Best case scenario on this transaction, about 125,000 Rand. Considering margin outlay of 110,000 Rand, getting more than double, potentially getting more than double your initial margin in the space of 3 months, we believe it's a very worthwhile transaction to get into. Our next slide is just once again a payoff profile. Excuse me. What will your profit and loss be at different spreads? As I mentioned, we got in at 320, the spread is now 540. Our best case scenario is a 20 Rand spread. That is what we were looking for initially. And once again, you'll see that up to 950, we're looking at a profit just below 25,000 Rand, with a best case scenario of just under 125,000 Rand. I believe this is me for now. As I said, I was very brief, and we would love to answer any questions that you may have regarding either of these transactions or any other hedging related queries that you might have. Thank you for your time.